In our last lesson, we learned about fundamental securities. We learned that stocks and bonds are really just a way of sharing the goodies that a corporation owns and the cash that it produces. In this lecture, we'll learn about stock markets, the institutions that let people like us buy and sell these securities. We'll learn that although the technology is high-tech and becoming more sophisticated every year, the basics are a lot like markets we encounter every day, such as markets for groceries or cars. If I asked you to think of a market for produce or for meat, then you'd probably feel comfortable with your understanding of the way those markets work. See, you have the main idea already. The rest is just details. Let's look more closely at the concept of a market. What is a market anyway? According to Merriam-Webster, the first definition boils down to just a meeting of people for the purpose of trade. There. That's all there is to it. You and I get together, perhaps in person, perhaps by phone or computer link, and we try to make a deal. Sometimes the goods are physically present at the market, like at a grocery store. Just about everything we buy is right there. We put it in our cart, and off we go. Sometimes the goods aren't physically present, even at the grocery store. For example, I might agree to buy a cake that you haven't even baked yet. There's nothing very mysterious about a market for food, is there? A market for houses is different from a grocery store in some ways. Apples at the grocery vary in quality, size, and price, but they're all pretty much the same compared to houses. Houses differ a lot more in a lot of different ways than apples. Sure, we expect apples to vary a few percent in price, but houses can differ by a factor of 10, and we aren't surprised at all. Houses differ in size and age much more than apples. I can do some repairs or update an older home, but I've never heard of anyone updating an apple. These factors make a big difference in the structure of the market for apples and the market for houses, but the bottom line is that these markets are just a meeting of people for the purpose of trade. The same is true for the market for stocks, which is often just called the stock market, even though there are many stock markets around the world. Stock markets are just places or financial networks that let people trade shares of stock. Markets that work well share common traits. Competition is at the top of my list. I want lots of potential buyers if I'm selling, and on the other side of the deal, you want lots of potential sellers if you're buying. Nothing protects consumers better than competition. High trading volume is another plus. If I know how much 100 different people paid for their 100 apples today, then I have a good idea of how much I'm going to have to pay for the 101st apple. If there are lots of trades being made every day, then my trade isn't going to push the price very much in either direction. I'm going to get a price pretty close to the price of the guy who traded right before me, and it's going to be pretty close to the price that the guy who will trade immediately after me will get. That makes it far less likely that anyone is getting cheated. The concept of liquidity refers to the ability for a seller to find a buyer and to be able to make a deal without any trades being done at fire sale prices or at premium prices either. Well-functioning markets require both parties to have confidence in the terms of the deal. I need to be sure that if I mow your lawn on time and the way I promised to do it, then you'll pay me the price we agreed you'd pay. Contracts, even with strangers, are enforced by law in well-functioning markets. For the most part, goods and services should be pretty much as advertised. Warranties must be honored. You need to know that I have clear title to the car I'm selling, and sure enough, institutions like title companies have evolved to ensure that you do. Well-functioning markets also have low transactions costs, or at least as low as possible. Let's consider the U.S. housing market. Are its transactions low cost? A standard realtor's commission on a nice home can be tens of thousands of dollars. That's a pretty big chunk of money. Don't forget to add a tax or two, plus a title search and a transfer fee. Then there are the costs of your time. showing the house to buyers who always seem to want to visit at just the wrong time is pretty aggravating. These costs make it less likely that people will buy and sell houses than they would otherwise. But that doesn't mean that realtors' commissions are unfairly large. True, some people buy and sell homes without using a realtor, and thanks to modern technology, particularly the internet, it's getting easier to do that with every passing day. Still, many people value the services that a realtor provides. Maybe they don't have the time to handle the phone calls and arrange viewings. Maybe they don't have the knowledge to do it, and they're worried about making a big mistake. Or maybe they just don't have the desire to do it. These people are willing to pay a realtor to handle the transaction for them. Yes, it's a big transactions cost, but there are thousands of realtors out there, and all of them are eager to have your business. They'll compete to get it, too, either by promising lower fees or, more often, better service. Given all of that, it's hard to believe that realtors' commissions are unfairly large. Large, yes, but they're probably as low as possible given current technology and market conditions. It's the best we can do under the circumstances. Information problems can interfere with markets, too. George Akerlof gave us the best example in his famous paper in 1970, The Market for Lemons, Quality Uncertainty and the Market Mechanism. For some items, such as used cars, the seller knows way more about the item's condition and value than potential buyers. If his car were in such great shape, then why would he be selling it? Does it have a bad transmission? A bad electrical system? Maybe the owner is selling it during winter so that the failing air conditioner won't be so obvious. Potential buyers can't easily tell, and they're not going to risk getting snookered. They may not know exactly what's wrong with the car, but they'll assume something is wrong with it, and they'll bid less. That's okay for cars that really do have something wrong with them. In those cases, buyers are right when they assume something's wrong with the car. They offer to pay the value of a car with a problem, and that's what they get, a car with a problem. All's fair in that case. Society, though, has a different problem. Someone who wants to sell a car that really is in great shape has trouble getting fair value. That's because buyers still can't easily tell if something is wrong with the car, and they still know that the seller knows more than they do about it, so they still bid less. In this case, though, that price is too low because the car really is a good car. This information problem makes the market for good used cars break down. It's hard to sell a good used car at the right price. Information problems are most pronounced for things that are hard to value because they might have hidden problems. Stocks can fall into that category, but the problem isn't as bad as it is with used cars. First, there are millions, even billions of shares in some companies. Exxon had almost 4.5 billion shares outstanding in early 2013. And you know what? They are all identical. That's not like that used Honda you saw yesterday on the dealer's lot. There's no other car identical to that one. The mileage is different, the care it has received is different, and the wear and tear on the tires is different. Stock markets have another advantage over the used car market. Somebody bought some of those identical shares of Exxon very recently. During trading hours, the most recent sale was probably just a few seconds ago. Lots of smart people are spending lots of time studying those Exxon shares too. If the price gets too high or too low, then these smart people will jump in and take advantage of it. We can see the prices of their trades too, just by going online or watching the news or going to the company's website. It's easy to see what other people think the shares are worth, and information problems usually aren't large. In fact, I don't even need to know the price that all those other people got. All I need to do is go online and contact a broker or tell the computer or the broker that I want to buy or sell my shares, and the financial markets will make sure that lots of buyers or sellers will see my offer. These markets are set up so that buyers or sellers must compete with each other to give me the best price. The genesis of the New York Stock Exchange was way back on May 17, 1792, when 24 stockbrokers got together under the now famous buttonwood tree in front of 68 Wall Street. All 24 signed what became known as the Buttonwood Agreement. They set the rules for buying and selling the stocks and the bonds that are fundamental to the financial industry. Today, we enjoy the benefits of efficient, low-cost securities markets. Our ancestors didn't have it so good. Trading stocks was expensive and slow. Communication was more difficult, record keeping was done by hand, and lots of paper had to be mailed back and forth. From that modest beginning under the buttonwood tree, stock markets have undergone an explosion in their influence on our economy. The financial services sector comprised just 2.8% of the United States gross domestic product in 1950. In 2006, just before the financial crash of 2007, it had grown to 8.3%. Growth in trading volume is even more dramatic. According to the World Federation of Exchanges, the dollar volume of stocks traded on the New York Stock Exchange, now often called the NYSE, about doubled from 1997 to 2000, then followed up by tripling from 2000 to 2008. From 2001, when Shanghai first made the list at just under 300 billion, until 2008, Shanghai's trading volume jumped 9 times its 2001 volume to 2.6 trillion. From 1929 to 2009, the total trading volume of stocks in the Dow Jones Industrial Average doubled about every 7 or 8 years, and starting early in the 21st century, it began doubling about every 3 years. All of that increase in trading volume hasn't been uniform across the world. In 1990, the New York Stock Exchange headed the list of stock exchanges ranked by trading volume. The Tokyo Exchange was second, while the London and Frankfurt exchanges ranked third and fourth. The National Association of Securities Dealers Automated Quotation System, or NASDAQ, which is essentially a computerized trading system, was less than 20 years old and ranked fifth. Shanghai wasn't even on the list of the big exchanges in 1990. By the year 2000, though, the advantages of the NASDAQ system had rocketed it to the top of the list of trading venues, and by 2010, Shanghai was beginning to flex its muscles as a world financial center, mostly at the expense of European exchanges in Tokyo. Those exchanges were still growing in trading volume, just not fast enough to keep up with Shanghai and the NASDAQ system. For now, New York, the home of both the New York Stock Exchange and the NASDAQ system, remains the financial center of the world, at least as measured by stock trading volume. Shanghai is making a big splash, though, and given the rapid development of financial markets in China, that's likely to continue. Europe and Tokyo show some growth in volume, but not enough to hold their relative positions on this list of 6 major exchanges. These stock markets are interrelated. Some stocks list on more than one exchange. Daimler AG, the parent of Mercedes-Benz, listed on both the Frankfurt and New York Stock Exchanges for many years. Generally, investors find it easier to trade on an exchange in their home country. The World Federation of Exchanges says the trading volume on the New York Stock Exchange and its related exchanges totaled over $33.5 trillion in 2008. Some people are wondering what companies can possibly do with all that money. The answer is that they aren't getting that money. Almost all of that trading volume is in what's called the secondary market. The secondary market is like the used car market. If I sell my car to you, then you pay me. The manufacturer, Nissan or Ford, doesn't get anything. Why should they? It's my car, not theirs. It's the same thing with stocks. If I sell you my Ford shares, then you pay me, not Ford. Ford just changes its records to record you as the new owner. Almost all of that trading volume results in money moving from the pocket of one investor to another. The company that issued the stock doesn't raise any new funds at all. The primary market is different. If Ford or Nissan wants to raise money, then it can have a seasoned equity offering, or an SEO. In an SEO, a company sells new shares, and that increases the number of shares already held by investors. In that case, Ford does get the proceeds of the sale of the new shares. Lots of people don't like to buy new shares directly from a company. The CEO of a company knows more about his company than just about anybody else. And if he decides that his company should sell shares, then they don't want to be buying. The CEO might be selling the shares because he knows they'll sell for more than they're worth, and he knows better than anyone else. After all, he's the guy that makes the key decisions that help determine how much the company is worth. Some of you may remember a Dilbert cartoon drawn by Scott Adams. The clueless boss says, "Our CEO says we are poised for huge growth in earnings." In the next panel, he goes on to say, in an unrelated move, he announced that he will leave the company before any of his stock options vest. That sets up the punchline. While Dilbert and his office mate Wally recoil in shock, the naive boss says, "The poor guy will miss all of our growth." I'm with Dilbert and Wally on this one. If the chief executive officer is bailing out, then I'm heading for the exits too. I don't care how much time you spend studying a company, you're not going to beat corporate insiders in the trading game. Of course, trading on insider information is illegal. A notorious example is Paul Moser, whom the Securities and Exchange Commission fined $1.1 million for his role in a Salomon Brothers bond trading scandal in 1994. Just a few days before the bad news about the scandal broke, Moser, then the head of the government bond trading desk at Salomon, sold 46,000 shares of Salomon for about $36 per share. Of course, after the rest of the world learned the bad news that Moser had been caught violating securities regulations, Salomon's stock price fell off a cliff. 2 weeks after Moser sold those shares, Salomon stock traded for less than $24 per share, down $12. If Moser had gotten away with it, then he would have avoided a loss of over $550,000. I'm not going to tell you that stock markets have eliminated trading on insider information. I do think that all of those smart people who spend so much time studying stocks have a good chance of catching it when it does happen, and the penalties for getting caught can be pretty stiff. The result is that most of the time insiders disclose their trades, and this affects the price they get when they do make them. John Cochran of the University of Chicago points out that people like us have more than just the regulatory apparatus to protect us. He says that short sellers, people who are willing to bet that the stock price is too high, uncover far more financial fraud than the Securities and Exchange Commission. They often see the fraud before the authorities, and if they do, then they sell the stock in anticipation of a big price decline. That probably happens with insider trading too. The playing field for trading stocks might not be perfectly level, but on major stock exchanges it's pretty close and way better than you'll find on some other exchanges in developing countries. We accept that computers are a fact of life these days. We take them for granted as record keepers and as transaction aids. Almost nobody really worries about this anymore. We've come to accept that machines diagnose problems with our cars, give us directions, and even land our airliners. Computers make stock markets much faster and cheaper to use, too. You can place an order to buy stock directly online using an internet brokerage account, and that computer will talk to the computer of somebody else who wants to sell. Done. That's much cheaper and less prone to error than having people write orders on paper and pass them around. For some people, though, automatic trading mechanisms, making trades without human involvement at that exact moment, does seem to be a little unsettling. Nobody doubts that the potential for problems exist. Two professors at the Massachusetts Institute of Technology, Andrei Kirilenko and Andrew Lowe, once wrote that whatever can go wrong will go wrong faster and bigger when computers are involved. Have to agree with that. The idea that we might get caught in a massive computer glitch probably isn't your worst nightmare, but it'll make the list of the top 10 for a lot of people. That's only half the reason people worry about computerized stock trades. The other half is the sense of being overwhelmed by the gigantic trading volume and incredible speed that computerized markets offer. We don't just feel like a minnow among sharks, we feel like a very slow minnow at that. I think that fears of computerization are overblown. Yes, big mistakes can happen in the stock market if a system fails or if someone programs a computer wrong. But that's no different than it is for, say, airline reservations or credit card statements. We'll first take a look at what can happen to traders if they're caught in a glitch. After that, we'll see if we can get a bit more comfortable with our status as slow minnows. Heavily automated trading platforms and computers placing orders can be scary. Mistakes happen. My favorite is the August 1st, 2012 Knight Capital Group debacle. Knight Capital, a financial services firm, endured, and I quote, "A technology issue at the open of trading at the New York Stock Exchange related to a software installation that resulted in Knight sending erroneous orders into the market." That's a marvelous understatement. Knight had lost about 4 times its annual earnings in just a few minutes. The next day, Thomas Joyce, Knight's CEO, explained what had happened. Knight had installed new computer software to trade on a new NYSE program. Unfortunately for Knight Capital, the software sent huge numbers of erroneous orders on almost 150 different stocks. Joyce explained, "It was a software bug, except it happened to be a very large software bug." Nobody can correct that many bad orders in a short period, so Knight had to eat the losses from those trades. Those losses were huge. This software glitch cost Knight $457.6 million. That was just about the entire value of the company. Knight was lucky in that it was able to get cash infusions from other institutions within 24 hours, but only at the cost of surrendering its status as an independent firm. The market showed no mercy. You mess up, you lose. I can't think of a regulatory agency anywhere in the world that could be so ruthlessly efficient. Mistakes can happen too. Badly programmed computers placed lots of erroneous orders on May 6, 2010, contributing to what's now called the flash crash. Securities exchanges decided that prices were way out of line during the flash crash, so they canceled over 20,000 trades that were executed during those few minutes. It's unclear how prevalent such problems are, though. Maybe the biggest danger is to the trading firms that use them. If your computer algorithm is going to be trading in milliseconds, then the computer code had better be right. Knight Capital showed us that you can lose enormous amounts of money in the blink of an eye. How might computerized trading affect you personally as a participant in the stock market? A consistent theme throughout our lessons is that people like us shouldn't try to be active traders and try to pick winners. For the most part, we're going to buy shares and hold them for a fairly long time. We simply can't compete with experienced trading firms that have invested gigantic sums of money in technology and who study markets just about 24 hours a day, 7 days a week. Take, for example, Project Express, owned by undersea telecom operator Hibernia Atlantic. Project Express was designed to shorten the cable link across the Atlantic to shave just 5.2 milliseconds, that's 5.2 thousandths of a second, off the execution time of the previous speed champ, the AC-1 cable. Project Express joins the FA-1 North cable with execution times under 60 milliseconds. This is a link from London to New York. These guys are approaching nature's speed limit, the speed of light, which would take about 40 milliseconds. About the only remaining way to go faster than they already do is to drill through the center of the Earth so that the cable would be shorter. Then it wouldn't have to follow the curvature of the Earth. A government report in the United Kingdom in late 2012 found that high-frequency trading could be beneficial by providing liquidity and what economists call rapid price discovery, meaning that if something happens that should affect prices, then it does, and very quickly at that. That's good. We don't want to be trading with someone who has private information that the current price is wrong, do we? We'd rather have the price adjust to fair value as fast as possible, even if slow minnows like us don't know just why it changed just yet. Most studies have found that high-speed trading, which means trades take place very fast, and its cousin, high-frequency trading, which means trading very often, lower the cost of trading for ordinary investors, including people like us. With high-frequency traders operating in the market, it's easy to find a buyer or a seller, and the price can't get too far out of line. These orders are only active for microseconds, a few millionths of a second. Such orders accounted for about 50 to 60% of U.S. equity trades and about 30% of equity trades in the UK at the time of the study. Some people think that high-frequency trading contributes to market volatility and is a tool for manipulating the market, and there's some evidence of this. We saw in Lecture 1 how computers can exploit tiny price differentials, for example. I don't particularly like being a slow minnow among sharks, but I take comfort in knowing that the sharks are all competing with each other for my business. That keeps me from getting hammered during the trading process. If shares in my company brought $100 when someone else sold a few minutes ago, then I'm not going to be too upset if high-tech trading firms want to fight over whether I get $99.99 or $100.01. I'm planning to hold my shares for a long time, and a few cents per share isn't going to keep me up nights. Spilling a glass of milk would cost me about as much. Every few months, we seem to see someone advance a proposal to limit high-frequency trading. The problem is that the proposals all pose difficult trade-offs. For example, some people want to impose a small tax on financial transactions like stock trades. The idea is that a fraction of a cent wouldn't be a big deal to people like us, but when multiplied over the vast number of trades that high-frequency traders make, it would be a significant deterrent. That might offer some benefits, but it might also reduce the speed at which prices adjust to news. The problem isn't as easy as it seems. We need to remember that I don't understand it, or I don't want you to play if I can't play too, doesn't necessarily mean the same thing as it's bad. In our next lecture, we'll explore the relationship between the risk of investing in stocks and the return we can expect to earn from owning them. We'll learn that stocks have had more than their share of ups and downs over the years. I'm not going to tell you that I know how to predict those ups and downs, but I can give you a better idea of what to expect. Just like anything else, when it comes to investing, the unknown is always scarier.